Hello, and welcome to Portfolio Matters. In this, the final weekly of the year, we incorporate some of the feedback we've had from our Discord members. And Richard and I are committed to another year of the podcast, and hopefully it will be onwards and upwards. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
So, Merry Christmas, everyone. This is our last podcast of the year, and I'd just like to take this opportunity to thank all our supporters and our Discord members for their contributions during the year, and in particular, our GoFundMe supporters who have been very generous, and in particular, Simon W. for not only his generous monetary donations, but also sending Richard and I half a case of wine from Berry Brothers. We really appreciate that.
Indeed. Thank you to everybody for your contributions.
Yes, and I've just noticed that this is spelt Merry Christmas, but there you go.
That's because you're thinking about 2022's financial markets, Keith.
Yeah, well, exactly. It's a better year for everyone next year, I hope. Okay, so thank you to all our Discord members who gave us some feedback on the weeklies, and in future we are going to incorporate some of their requests, and that is we aren't going to read out all the checklist data. We will leave it on screen for people to read, and we will concentrate just on the big movers. We will go through the charts though each week. In addition, we're going to try and suggest investment ideas arising from the news, and actually that is something that we should do, and which I would personally find very useful as well. And then when we discuss our own trades, we will give you an idea of percentage that we are committing to the trade and our conviction in it. Thank you to all our Discord members for their feedback. Okay, so there wasn't much economic data this week, but there was a lot of news. So the EU did not agree changes to its energy policy in the face of astronomical gas and energy prices, which we will show you as we go through this week's weekly.
Indeed, in fact, this morning the FT, the EU is hoping to raise €12 billion euros, from its carbon trading. So it sees it as tax.
Yeah, and I noticed that finally the energy prices is front page news in the FT and on Bloomberg. I'm not sure whether it's got to the tabloids yet, but hopefully at some stage it will do. In the US, Biden's infrastructure bill is looking unlikely to pass currently due to the opposition of one Democratic Senator, Manchin. Now, the question is whether he is posturing and aiming to get a better deal for his constituents. But if that fails to pass, that will have an impact on US economic growth in 22-23. Chile has elected a new far left president, and if you have investments in any Chilean copper miners, you should be concerned. So companies like Antofagasta, the new Chilean president has said that essentially he's going to try and raise taxes and reduce permitting for the mining sector. And China cut its one-year prime interest rate by 0.05% from 3.85 to 3.8%. But, it's symbolic, easing monetary conditions slightly. Toyota have announced that 4 of its factories will close in January due to a lack of spare parts. So the continuing supply chain crisis is having effects into 2022. There is little evidence that it's getting better. And finally, China has locked down the city of Xi'an because of COVID. Okay, so this week's economic data. Well, there wasn't much. We did a huge dump last week, and there's not much this week. So the German IFO Business Confidence Index dipped down to 94.7, which is below expectations. And we'll show you a chart in a minute. It's not looking good. UK public sector borrowing for November came in at 17.4 billion, well down on October and below expectations. Not great. And in the US, good news. US existing home sales was 6.46 million at an annualized rate, which was slightly below consensus expectations, but up on October, and is a very healthy number, frankly. We did, however, have some quarterly data. So the UK current account balance came in at minus 24.2 billion, well down on Q2 and below expectations. And if anyone read the piece in the FT about the travails of a UK wine importer and the red tape he was going to face from the 1st of January next year, then we should be concerned about our trade links with Europe and our trade balance. UK GDP growth year on year in Q3 was a very healthy 6.8%, but the quarterly growth rate was poor. It was only 1.1%, and that was below expectations. Business investment fell by 2.5% quarter on quarter, which is not encouraging. In the US, corporate profits quarter on quarter in Q3 was 3.4%, and that is a big drop on Q2 and a big drop compared to consensus expectations. So that is bad news for the stock market in the US. Corporate earnings are disappointing, and real consumer spending in the US was 2% in Q3. That's an annualized rate, which is a big drop on Q2, but better than expectations. Okay, so onto the charts. Richard?
Well, the German IFO business confidence, clearly it is dropping significantly. We were questioning last week whether it was just one of those sort of statistical blips, but it looks like a trend is in place. And I would imagine that apart from anything else, Omicron, the lockdowns and Omicron and the soaring energy prices must have a hugely deleterious effect on European business confidence across the board. And UK public sector borrowing, clearly, the UK is dependent on the confidence of the markets in terms of being able to sell government debt now, and as are many countries. And that's a danger, isn't it? That we are spending much more money than we have available to us. We already increased tax rates to the highest they've been in 70 years, I think, 1950s, or Dennis Healy or wherever it was. And there is not much more give in the system, I think. Well,
you notice there's a big structural break here between pre-COVID and post-COVID.
Yeah, exactly. It's not sustainable.
Yeah, absolutely. It's not sustainable.
And the UK current account deficit, the UK current account deficit has looked unhealthy for a long time. And you could argue that it is the trend is that it's improving. The problem is you don't, not from a very good position, admittedly, but in like 2019. But it is in a poor state at the moment. One has to hope the trend will improve, but it is not healthy at present. And the US existing home sales, a vibrant, buoyant market.
Some update charts on the US economy right now. So this is the Atlanta Fed's nowcast, and we were concerned in previous weeks that there had been a big fall. Well, the big fall did not continue. It's actually bounced back and is at a very healthy level. The Atlanta Fed is forecasting US Q4 GDP growth at above 7%. Now, we know that it's not terribly accurate, but it's nonetheless good news. And if we look at the St. Louis Fed, that is forecasting GDP growth of almost 5%. And these are strong numbers. Now, I should warn you that the New York Fed has withdrawn its nowcast because of the volatility in the numbers. And it thought that because of that volatility, its nowcast had become unreliable. And the past two charts should be interpreted in that light. Okay, on to inflation watch. No new data this week. We are awaiting Japanese inflation, which is very low, but a reminder, the general picture is of very high and rising inflation across all Western countries. So we featured this chart last week, which shows lumber prices in the US. And thank you to Albert S., who explained that rising lumber prices are due to flooding in British Columbia. So supply constraints. The ECB, this is the ECB balance sheet. The ECB continues to print money. Now, last week we discussed the fact that the ECB were going to withdraw their pandemic emergency purchase program by the end of March, but they're going to partly offset that by reinvesting any bonds that mature, and they've extended that program to the end of 2024, and we suspect they will continue extending that because they need to support Greek bond yields. But now the ECB balance sheet is equal to 81.6% of the Eurozone GDP, which is larger than both the US and the UK, and only below Japan's, and Japan's is extraordinary. So this is an illustration of that. This is central bank holdings of government bonds as a total percentage of total issuance, and the Eurozone is rapidly approaching Japanese levels and has far exceeded US levels. And while we discuss inflation, the tight labor market, so the current US unemployment rate is below the estimate of NERU. Now, NERU is a monetarist term, and it is the non-accelerating inflation rate of unemployment. So monetarists would expect that when employment goes below that number, the labor market is tight and you start to get inflation. And that's what we're seeing. So watch this space. This is US consumers' spending intentions for next year, and they are good. So the US consumers with earnings below 50K are expecting their spending growth to grow by 9.2% next year. And we know that lower paid workers have seen high earnings growth. In contrast, richer US consumers are still going to spend, but increase their spending by 5.7% next year. But obviously that's below the 9.2% of the lower wage earners. And a reminder, this is the UN Food and Agriculture Agency, their index of world food prices, and they are high and rising. And when they are last at this level in 2011, we had the Arab Spring and unrest in poorer countries where people spend much larger proportion of their income on food. Okay, Richard.
Yeah, thank you, Keith. So I think a lot of the information that we're getting suggests we may be moving into a stagflationary period. I know that it's a contentious point of view. And you can look at the US economic growth and say it's enormous. I mean, one of the pushbacks on that is that they are understating inflation significantly. And so if you understate inflation by 4% and you're saying you've got GDP growth of 6%, what you've actually got is GDP growth of 2%. So I'm not convinced by the GDP numbers. So this is a chart of savings and income drops. So we've got basically savings as a percent of disposable income in black, and we've got month over month inflation in blue. And what this is saying is that effectively the real spending power of people is dropping.
Now, I'd just like to push back on this chart slightly, Richard, in that I'm going to show you a very similar chart later, which I think is a better interpretation of this savings number, because I mean, one thing that's puzzled me is that I've heard various commentary on Twitter saying that all the savings that US consumers had built up during COVID had now been spent, and that this chart in the black line would seem to suggest that. But you know that the US has increased the money supply by 30%, and if that money is not in people's savings account, then where the hell is it? Now, and I think actually the way this black line should be interpreted is that this is the savings rate, and the total savings, extraordinary savings, is the area under that line, under the black line. So people still do have savings.
Okay. So this is a graph of the real average weekly earnings, which shows that suggests that spending power of the US citizen is dropping, not rising, which is what you expect in an inflationary environment where wages aren't keeping up with the price increases. So, and this is sort of putting together a thesis, really. So, Keith, the next chart. So the global credit impulse, I think we showed this graph before, didn't we? But basically what's happening here is the global credit impulse is slowing down. And this is a great little chart from picture from the Financial Times today. Basically, the source is Pedigo. So Pedigo sell electric bicycles in the UK, and what it shows where the parts are sourced from. All the parts are sourced from China or South Korea, but some of the parts are now being sourced from elsewhere as they're trying to break up the supply chains to give them more resilience to the supply chain. But the lead time for parts has risen to 9 to 15 months from 2 to 4 months. Now, that is eye-watering. Yeah. And the quote is, I've got 200 dealers. I get a container of 150 bikes. What am I supposed to do? How do I allocate them fairly? Well, you can't, can you? So, and we discussed last week what's happening to, I think we discussed it in the recession piece that we did during the week, and what's happening to supply chains. And my thesis is that the supply chain problem is getting worse, not better, and that people who say the supply chain issues will be resolved shortly are wrong, because the supply chains are far more complex than they understand or they wish to admit to, depending on their point of view, where they stand. So I think that we have very significant supply chain problems. The fact that Toyota are going to be closing 4 factories in the new year because they can't get spare parts now, I assume that means parts for their production lines.
Yeah.
So this is a story that is not going to go away, and that I believe is going to get worse. And I think we need to position our portfolios for it to get worse. So the next slide, please.
So, but briefly, Richard.
Yeah.
So what you're saying is that continued supply chain disruption is going to hit manufacturers, and so the investment implications of that would be essentially industrial sector is going to be hit quite hard. And because of the disruption, presumably primary commodities going into manufacturers would also be hit.
Well, I think that's a very interesting question, Keith, and I think there's quite a lot of analysis to be done on that. And you may be right, but it may also be that the situation is more complex than that. So I'm actually not really coming up with answers at the moment. I'm expressing what I believe the problem to be. Now, this is interesting, and it is the thing. This is about Afghanistan. Millions face starvation this winter after withdrawal of foreign aid. There is growing pressure on Western powers to unfreeze assets and reinstate state support, despite fears that it could reinforce the Islamists. What's happening in Afghanistan is the whole system is collapsing. And the whole system is collapsing because it was dependent upon the financial support of the United States, effectively. And Afghanistan has had all of its support frozen. Sent the World Bank has frozen access to any funds that the Taliban government might have had. And it is basically totally destroying the economy and pushing it back into a pre-industrial economy. That's what will happen. And I think there's a lesson here, which is if you mess with the economy too much, you don't know what you're doing, you lose control of it in ways you cannot predict. And this economy is crashing at a huge rate because it is being denied one resource. That one resource is cash. So moving on. Stagflation in Spain, possibly. Producer prices in Spain increased 133 points in November, 233. So the Spanish PPI is 31%. So the producer price index in Spain, inflation is 31% year on year. And it used to be called the wholesale price index, the PPI. So for those of you who are of my generation, I remember the whole wholesale price index from the 1970s. Now, that's going to feed through into Spanish consumer prices, inevitably, and it's going to feed through at a similar rate. Well, it's the Spanish economy growing at 33% GDP before absolute GDP before inflation. Well, of course it's not. So what's Spain got? It's got stagflation. Or if it doesn't say it's got it now, it'll have it in 3 months' time. Or, that's what's happening.
Well, or corporate profit margins get hugely squeezed.
Yeah, well, and then in which case businesses go out of business because at 30% input costs, you can't stay in business if you can't raise your margins. You go out of business, you go into recession. What is that? And that's stagflation as well. Was that the last one, Keith? I can't. Oh yeah. So now, final point: U.S. financial conditions remain near their loosest on record. So great, they're at their loosest on record. GDP is growing at, well, depends what you believe, doesn't it? 4%, 6%. Add on a bit of extra inflation, they're not reporting. GDP is hardly growing at maybe 2 or 3%. Loosest financial conditions on record. GDP should be growing at 15 or 20%. Why isn't it? Take away those loose financial conditions, i.e. the government spending, government borrowing, put interest rates up to a level they should be at. What have you got? Massive recession.
Well, I think the US economy is not growing because of lingering effects of COVID, both formal. So, the fact you have vaccine mandates and people don't want to go back to work because they're nutcases who, don't like vaccines. Or there are people just scared of COVID and would prefer not to mingle.
That's true, Keith. Is there one more slide? I'm sorry, I can't remember. Yeah. So this is the final slide I put in, which is national gold reserves, and you'll be able to start seeing where my mind is moving now in terms of national gold reserves. But interestingly, the UK has gold reserves of 310 tons. Thanks to Gordon Brown, we would have had more than that. But in his infinite wisdom, this is a don't get me started moment. I'm sorry. Turkey, interestingly, has 687 tons of gold, and it may well need those very shortly. And there we go. China has many, many, many more thousands of tons than it admits to. And so, and actually Turkey is interesting. I'll try not to ramble too much here, but Turkey is interesting because yesterday or a couple of days ago, effectively what Erdogan said was, you don't need to put your money into gold, Bitcoin, or foreign currencies because your savings will be guaranteed to be uplifted by whatever the rate of inflation is when you leave them in Turkish lira in the bank, which is what? Actually, it is an interest rate rise of, given what their inflation rate is, it's an interest rate rise by another name to around about 20%, but funded by Turkish lira. And apparently they've spent 7 to 8 billion of their foreign currency reserves in supporting their currency.
Yeah.
So my thesis is that we have massive supply chain problems that are going to get worse. We have huge incipient inflation in the system. We have an energy crunch, which is going to batter industry, and actually it's going to batter the consumer. We have Omicron, which is causing at least panic amongst states, if not serious damage to individual citizens. I think that remains to be seen. And we are, I think, moving into we're moving towards a discontinuity. So economies tend to run, and then when they go seriously wrong, there's a discontinuity, and the rules don't apply anymore. I think we're heading towards a discontinuity in this. And my portfolio is positioned as best I can for that discontinuity. And if I'm wrong, then I am wrong.
Well, I don't think we're heading for stagflation, Richard. But so I don't think we're heading to stagflation because I am optimistic that when the COVID restrictions come off, then we'll have an increase in the labor supply. And I think actually a lot of the inflationary pressures are transient. But the longer supply chain issues persist, the longer the inflationary impulse will persist. And also, Europe really needs to get its energy policy sorted out. We will go into this in some depth in a little bit.
Yeah.
But like you, I am actually largely positioned for stagflation because I've got loads of oil. Now, what would I rather have? Loads of British pounds, which they're printing the hell out of, or loads of oil, which the world really needs, and we seem to have. Yeah, it can't be printed.
So a couple of graphs on China. This is just a sort of an update, really. This is the China Property Index, share prices of property companies, where you can see it sort of doubled up from 2016 up to 2017 or so. And since then, it's been on a sort of progressively downward path and is now back to where it was 8 years ago. And then the next graph is the offshore defaults of Chinese corporate bonds have surged to a record in December. So these are corporate bonds of property companies, and the defaults are massive, and I suspect are going to continue and possibly get larger. China has a real problem in its property market, and it is not going to be able to resolve it quickly and painlessly.
I'd also say it's one of the most predictable crises in history.
Yeah, and it's been predicted for 10 years, hasn't it? Which shows actually how difficult it is to get your timing right on predicting.
No, that's true. But it's a risk you never needed to take, knowing that eventually there has to be a crisis. I mean, the people who bought Evergrande offshore bonds. Okay, so on to the European energy crisis, and it has got a lot worse this week. So it's suddenly becoming news and having real effects. So the aluminium smelter in France has been closed down for 2 weeks. I'm amazed it's just 2 weeks. Trafigura have closed down a zinc smelter in France, and Romanian fertilizer producer has temporarily halted production.
So that equates to supply shortages and price increases.
Yes, we will go into this. So Russia have been playing silly buggers. So this is the flow into the Malnau facility in Germany, and they actually reversed the flow earlier in the week. So instead of flowing gas into Germany, they withdrew it. But overall, Russia is still sending gas to Europe, but at a much lower rate than in previous years.
Russia has realized it actually crippled the European economy.
Yes, absolutely. And these are daily power prices for 2 days ago, and astonishingly high levels. 382 euros in France, 331 in Germany. Bear in mind that we're talking about historic levels of 30 to 40. And this is the UK. This is last Thursday, actually. Today, yeah. Front month baseload electricity prices hit £490 a megawatt hour, down from 50 earlier in the year. German electricity prices, frankly, every time I look at this chart, it's gone up. I've had to revise it a couple of times.
Yeah.
French power prices. Now, Richard mentioned last week that there are 4 French nuclear plants going offline because of cracks in the cooling system. Yeah. And the market is forecasting supply crunch to last into next year. So this is German 1 year ahead power prices. And this is a really frightening chart. Earlier in the year, 1 year ahead prices were 50 euros. And now they're approaching 350. And how any manufacturers or primary product producers like steel producers can survive this, I just don't know. And so when you talk about the knock-on effects of this, and hopefully in the coming week, we'll do a short piece with some investment ideas arising from the European energy crisis. But the knock-on effects will be that energy consumers, such as aluminium smelters in Europe, will all have to go offline. So buy aluminium smelters in jurisdictions with lots of renewable energy like Iceland and Canada, or Norway, which is all hydro, because reduction in aluminium production in Europe will raise the aluminium price. And if you have long-term contracts for cheap renewable electricity, then you should do well. Now, fertilizer prices are going through the roof. Now, that is going to be very bad for farmers who will probably cut down on their fertilizer use. So next year, you're likely to see higher grain prices, we would expect.
Either way, food prices go up. Either production drops and prices go up because there's a shortage, or production stays the same and prices go up because they've had to spend a lot more money producing it.
Yeah, now I'm actually not sure whether this is good or bad for farmers, because they have to pay more for fertilizer, but it could well be offset next year by very high food prices. So not sure the effect.
Just remind me why you think food price inflation is transitory, Keith, or inflation is transitory.
Well, yes. Well, this energy crisis actually should be transitory. I'll show you a chart in a minute.
I agree.
So this is the problem for EU aluminium smelters, because remember, aluminium is essentially coagulated electricity, and the pink line is French baseload power, and the black line is the aluminium price. Your costs have gone through the roof. Your sale price has hardly moved. You're getting crushed. But US to the rescue. There are 24 US LNG vessels en route to Europe. Essentially, Europe is outbidding the rest of the world for global LNG cargoes. So hopefully these extraordinarily high prices should begin to come down as those cargoes arrive. But they're not going to come down to the levels they were last year. They're going to come down from these very high levels. But we're only getting these cargoes because we're outbidding Asia. Okay, so moving on from that cheery section onto the macro outlook for 2022. And frankly, it doesn't look that bad. So these are all charts from Evergreen GavCal, and they are saying that the incomes are rising naturally as government transfers come down, and that the economy can self-heal in 2022. Now, this, going back to what I was talking about earlier, the excess saving, they estimate at about 14.75% of income. So US consumers have excess savings that they can spend and fund growth in the coming year. And we worry about fiscal tightening, but it's already started to happen, and the US economy is doing all right. And GavCal are forecasting that it will be able to survive the expected fiscal tightening next year, which is well signposted. And a reminder that the Fed's fund rate continues to be at zero. We've got good wage growth, although, as Richard has pointed out, inflation is even higher, leading to fall in real living standards currently. But, income growth is very strong in nominal terms, though not in real terms. And the red line here is the employment rate, which is rising rapidly. The blue line is the participation rate. And you hope, as COVID concerns start to disappear, that people come back into the market, labor market. Okay, other charts. Okay, first of all, a clarification from last week. So we showed this chart, which is passengers transiting through Hong Kong, and we were perplexed by the fact it has absolutely collapsed. Well, it's collapsed by government fiat. So Hong Kong have very stringent quarantine rules, even for vaccinated people. And you're only allowed to inbound to Hong Kong if you're a resident there, and quarantine is 21 days in assigned hotels. Anyone tested positive is consigned to a camp. Yeah, no wonder nobody wants to go to Hong Kong. You end up as a guest of the Chinese government. So, talking about supply chain issues, and this is the US, and it is retailers' inventory to sales ratios, and it's not good. So, US retailers could well end up short stock this Christmas.
And there's an interesting point here. I'd just like to. So there are these algos, particularly operating in the US now, where when they scrape the internet for orders, and where a particular product is seen to be in high demand, the algo steps in, front runs the orders. The individual buys whatever the product is from the online retailer and then remarkets them at a higher price. And apparently, you can make quite a lot of money doing this. Well, this is arbitrage, clearly. But what he's actually saying is that the price of the good at which the good is being sold is too low. And someone is stepping in and saying, if the price is too low, I'm going to take the difference. What that actually means is that the price of the good being sold will go up. So the manufacturer and the retailer take the profit, not the arbitrager. So ultimately, there is actually a big chunk of inflation in the system that's going to caused by supply shortages. It's actually going to come out this way as well.
Well, that's it. This is a really interesting conversation, Richard, because you remember the fuel prices earlier in the year. Britain had a fuel shortage, and UK petrol retailers did not raise prices, which would have been the rational thing to do. And instead, there was essentially rationing. So there are huge queues outside petrol stations. And the reason they didn't raise prices is that they feared that they would suffer reputational damage, and that when prices came back down, that consumers would be annoyed with them and go to retailers who had not raised prices. Now, that is possible because you have this relationship between the consumer and the brand. And when things go online, then these intermediaries essentially can come in and remove that, arbitrage that away, basically.
Yeah. Interesting point.
Okay, so these are the sales of US car makers, and they have collapsed because of supply chain issues. And the same is true for Europe. So supply chain problems are having continued effects, and we've seen that Toyota are closing 4 factories in January. So this isn't going to get better. Richard.
So this is saying that China's credit impulse has turned up. So the 12-month impulse hasn't really turned up. It's a blip in the line. And the 6-month impulse is turning up, which suggests the 12-month impulse will follow it. All this means is that China is now trying to stimulate its economy, and it has to because of the huge hit it will be taking. Remember that residential property is about 30% of the Chinese economy, and the residential property sector of the economy is clearly in serious trouble. So China is in trouble. The Chinese economy is in trouble in that regard.
Okay, now returning to supply chains, this is a very interesting survey from the FT, and this is how companies were intending to change their supply chains going forward. So this is data back from May and compared to 12, what they've actually done. And so back in May 2020, this was, they were intending to reshore, to get their manufacturers of spare parts closer to them. And actually, 1 year later, that hasn't happened. Instead, what they've done is increased inventories. So they've been unable to reshore, and they're going to have to run higher inventory levels going forward. Now, that means they're going to have higher stock, higher working capital, and that will mean presumably there's a one-off hit to cash flow, but an ongoing reduction in return of capital employed.
Yep.
Okay, so COVID. This is COVID in Gauteng, and it seems to have peaked. Hurrah! And we're going to show you some contradictory data on South African COVID cases, COVID deaths. So COVID deaths are very low levels, despite the new cases rate having gone through the roof. But the FT has more concerning charts, and their charts, you'll notice, are just from Gauteng, not from South Africa as a whole. But they're showing that although cases in Gauteng have peaked or are peaking, that excess deaths are still rising, are on a path.
But excess, the death pros come after the rise in the positivity test, because it occurs a number of weeks after infection. So actually it will continue to rise for probably 3 to 4 weeks after the peak in the infection rate.
Yes, but their point is, Richard, that this is on the same path as previous waves. So they're saying it's not less deadly.
Yeah, but it would be on the same path as previous waves. You're saying the gradient is the same?
Yeah, well, the absolute numbers, compared to previous death rates, cases, then if it was less deadly, you'd expect the death rates to be lower, this line to be shifted downwards.
Right.
And it's not. This is case from the UK. And you see the case numbers have gone absolutely through the roof, but we're not seeing much of a pickup in deaths or in ICU patients.
And indeed, if you look at the previous peak in late December 2020, the death rate and the ICU rate followed very closely the curve of the infection rate, and these are not doing so.
Yeah. And the South African data would seem to support the case that Omicron is much less deadly than previous variants, 25 times lower. Now, we've been reading in the UK how the scientific advisory group to the government are forecasting a huge number of deaths, but they've always been consistently pessimistic. And so if you look at their previous prognostications in the winter scenarios for 2020, all these lines were their forecasts, and the black line is actual, and the black line was lower than any of them. And this is SAGE scenario for September, when they're expecting another wave. Essentially, there wasn't one. I mean, they always look at the worst case scenario and then recommend locking down the entire country.
They have a real credibility problem at SAGE, and it's exactly as you say, Keith. They don't present a balanced view. They don't present a balance of risk. They simply wish to present the worst case scenario. And I frankly do not understand the psychology of that process, because it is irresponsible to simply continually push the worst case scenario and deny effectively that it is a worst case scenario. So yeah. There's something came through while we've been recording this. I'm just going to read out 3 doses of Sinovac vaccine, which is the Chinese vaccine, ineffective in dealing with Omicron. And that suggests that China is going to have a significant problem with Omicron, because, as we know, it's highly contagious, far more contagious than the Delta variant. And clearly, vaccination is a powerful weapon in keeping it at bay. We don't know how powerful, but it is a powerful weapon in keeping it at bay. Yeah. And if the Sinovac vaccine is ineffective at that, then that is a real problem for China, because the majority of their population is vaccinated with Sinovac. And it's also a problem for a lot of other countries that have used the Sinovac vaccine. So if this is true, a laboratory study is reported to have found that 2 doses in the booster of Sinovac COVID-19 vaccine did not produce sufficient levels of neutralizing antibodies to protect against the Omicron variant. If that's true, we're going to see more supply chain problems.
Yes, agreed. Buy your Chinese manufactured items while you can. Okay, on to...
But don't open them. Just keep them for a few weeks and then flog on.
Yes.
We said we'd come up with some investment strategies, Keith. I think we've just done it.
Okay, moving on to the weekly checklists. First of all, equity markets. So it was generally a positive week for equity markets. NASDAQ had a bounce, as did Bitcoin. Now, as it's the last one of the year, we'll quickly review how equity markets have done this year. And they've all generally been strong. The S&P 500 has actually been the best performer and has outperformed the NASDAQ. So the S&P 500 is up 25%, the NASDAQ only up 20%, and that's interesting. Tech has actually started to underperform now. The all share, although put in a very respectable performance of up almost 14% on the year, lagged over 10% behind the US indices. Bitcoin had a great year. Richard?
Yes, it's not doing very much at the moment. It has had a great year, hasn't it? I think there's a lot of push and pull going on. Some people think it's hugely overvalued. Some think it's going to go up by a multiple again. Basically, Bitcoin and Ether are going nowhere and have gone nowhere now for a couple of months, I think. I am still invested in the crypto markets.
Good for you, mate. Okay, so this is the relative performance of cyclicals versus defensives. And you'll see that there's been this huge sector shift in the last couple of months on the year. It's as though the market is actually moving back into defensive mode and has become worried about future economic growth. And frankly, this is the underperformance of my portfolio in one chart. Now, what is interesting is that the PE ratios of US information technology companies continue to increase, whereas the PE ratios of value companies continue to decline. And the PE ratio expansion of US tech is now not supported by increases in earnings per share. So you see, earnings per share is actually been declining recently. So how long? That cannot continue forever. So this chart would say, get out of tech. But there's still a lot of money flowing into equities. Now, thank you to Leebod of our Discord channel for sending us this. And this is the world market total globalization of the equity markets by country. You'll see, due to its continued outperformance, the US is now approaching 45% of total world capitalization. And frankly, whenever a single country has started to dominate the world market indices, that's always been a sign of a huge bubble. Remember Japan back in the 90s?
Yeah.
Warning signs. Okay, now on to the big story of the week, and that is energy commodities and natural gas prices. And European natural gas futures rose an amazing 38.9% from already elevated levels, and they are up 804% year to date. And if you look at this table, energy commodities have had an amazing year. Although my own portfolio, which is 70% oil, has had an indifferent year. So this is the crude oil chart, a bit of a bounce back, which is good. There are continued crude draws in the US. Going through some charts, well, Rystad have revised down their estimate of Russian future oil production, and they're now saying essentially that Russia is almost out of spare capacity. A reminder that oil and gas investment continues to be very low, and it can't continue at these rates if we continue to use fossil fuels at the current rate, because frankly, we will just run out and then we'll have an enormous energy spike. We're already seeing that in gas. And so they're estimated that we're going to need another $600 billion worth of capex in the next 10 years if we're not going to have an energy crisis. And when you look at oil production long term, you'll see that even prior to COVID, oil production had peaked back in November 2018, and we're now quite a long way down from the peak. And further problems with supply. This week we had disruption in Libya. Basically, the militia closed off this pipeline here between Shahara and Zawiya. And Libyan oil exports are estimated to have fallen from around 1.2 million to below 1 million. And France is burning oil because gas prices are going through the roof. They've closed down 4 nuclear power stations. And global onshore inventories are falling. Now, because we have somewhere, we'll show you in a minute, the graph of showing gas prices in oil terms. And gas prices in Europe are much higher than the oil price. So if you can burn oil, you're going to burn oil. And global oil inventories are low and falling, and the switch to burning oil for power production will only increase the rate of decline. So moving on to Dutch natural gas futures. Now, previously in October, we thought that gas futures were absolutely extraordinary, and they have gone parabolic since there. This is a huge problem and is becoming news. Well, it should be news. So this is the European natural gas price in oil terms. And so this is from earlier in the week, and the Dutch natural gas futures are equivalent to $200 a barrel oil. Europe is competing with Asia for natural gas. So you'll see spike in Dutch natural gas futures is mirrored in Asia and in the UK, but in the US, where it's well supplied, it's picked up a bit, and that is an arbitrage. If you can liquefy US natural gas and export it to Europe, and as we've seen, there are 24 cargoes on their way, that is an enormous profit. And investment idea, Cheniere Energy have a big liquefaction trains, and they specialize in this, exporting LNG. And I bought a bit this week, as we will discuss later. So despite the record gas prices, Europe is still drawing down its gas stocks at a very high rate compared to history. So this is the change in storage between the 1st of October and December the 19th in various years. This is from John Kemp at Reuters, and you see the rate at which we're drawing down gas this year is high compared to the average year, and we've already drawn down 20% of our stocks because our stocks are low. And that is despite relatively mild temperatures in continental Europe. As in recent days, temperature in Frankfurt has been above the seasonal norm by up to 4 degrees. So as a result of all that, markets are expecting gas prices to remain elevated throughout 2022. Coal prices have been picking up again from their big drop. People are going to start burning coal if they possibly can. And this is forecast for global coal consumption. Essentially, declines in Europe are offset in China and India, actually particularly in India. So over the course of the next 3 years, you're actually expecting to see a slight increase in coal consumption. Finally, onto uranium, which has stabilized basically. But last week, we showed you this chart, and I was saying, well, it's slightly unfair because the French electricity prices have gone through the roof as well. Well, I revised that. This is absolutely correct because, as one of our Discord members pointed out, on the 31st December, Germany will close 3 of its remaining 6 nuclear power stations into the worst European energy crisis ever. What are they going to do? They're going to burn more fossil fuels. And actually, while we're on that subject, I notice that the UK has resumed burning coal. France is burning oil. Germany is burning loads of coal, and nobody is complaining. Essentially, when it comes down to keeping the lights on, we'll do anything. So this ESG-led energy transition currently is leading to burning more fossil fuels because we're closing down the nuclear power stations. Finally, on to commodities, Richard.
Yeah, I mean, I agree, Keith. The reason I haven't said anything is because I don't know what to say. The situation is the result of such irresponsibility and incompetence collectively by our politicians and bureaucrats. It leaves one speechless. Anyway,
sorry, Richard, before you go on, I'd just like to say that one thing that we haven't seen is the governments of Europe addressing the energy crisis. They have committed to continuing with the energy transition. without addressing this huge energy spike. So what we haven't seen is the UK, for example, saying they're going to reopen the Rough gas storage facility. And if we don't address this, then Europe is going to suffer much higher energy prices than the rest of the world, which will have huge economic impact on UK manufacturing, etc.
They simply have lost the plot. But you and I can moan and bemoan it as much as we like. There's virtually nothing we can do about it, and to rectify the situation. So moving on to the industrial commodities, let's just look at the annual change. So effectively, all of them have had substantial annual changes except for iron ore, and some of them had huge annual changes. And looking ahead to 2022, do we see any reason why this trend is a one-off, one-year trend? I think the answer, generally speaking, is no, we don't. Aluminium, we've discussed, electricity shortage, plants shutting down. Cobalt is a battery element. Copper is electrification.
Some of them, like the only ones I'd say that I think will come back down are ones such as lithium, where I think the shortage is temporary.
Yeah,
we don't have a shortage of lithium. Essentially, we just haven't been looking for it.
Yeah,
and so I think as the supply will increase, and I think the same is true for neodymium medium term.
Yeah, it's a question of how quickly the supply increases, isn't it?
Yeah.
Well, I think that's the takeaway from this. That there are many of these commodities probably remain a good investment for several years to come.
Well, copper in particular, we know the inventories are falling rapidly,
and
aluminium and magnesium, which are both basically congealed electricity. If you have a producer with low electricity costs, such as in Iceland or hydro in Norway, then that looks like a good investment to me.
Yeah.
As we've just discussed, we're expecting the aluminium price to rise because power prices are rising, so that will surely not go through to aluminium. And investment ideas, and thank you to Simon W. of our Discord channel for suggesting these, but Rio Tinto have largely aluminium operations in Canada where they have hydroelectric power. Alcoa have hydroelectric plants in Iceland, for instance, where it's again geothermal power, which is on cheap long-term contracts. And Norsk Hydro have aluminium smelters driven by cheap hydroelectricity in Norway.
Copper stable, but we believe the price is going to go up substantially over the next few years. The reasons we've discussed. Copper inventories are continuing to deplete. 2021 is the red line at the bottom. Inventory is lower than it has been this year, and previously we've shown graphs showing that the inventory in metal exchanges is extremely low. Chromium is an additive for steel production. I think there's some debate, some question mark over steel production given what's going on in the Chinese property market and the car industry. And I think so chromium, iron and ferrovanadium, there is a little bit of a question mark because they tend to be linked to the price of iron.
So iron ore has come off heavily in the second half of the year because of mandated reductions in Chinese smelters to conserve electricity. But as Chinese power problems ease, so they are ramping back up, and you're seeing a rise in the iron ore price.
Lithium we know is highly in demand as a battery element, and there is a supply shortage at the moment. We don't really know when supply is going to come on stream, so that I suspect that will continue to increase over the next 12 months because I don't think supply can come on that quickly.
Yeah, this is bad for electric vehicles. I mean, you're seeing all the costs, the elements that go into them going through the roof, and they're already they're twice the price of internal combustion engine vehicles. This isn't good for the energy transition.
No. Magnesium, we've discussed the problem with magnesium simply is that the only people who can produce it are people with access to hydroelectricity, and that's Chinese. And the Chinese have squeezed the rest of the world production out from the market. There isn't very much production apart from in China. And magnesium is needed for lightweight, strong alloys, such as are used in car production.
Neodymium seems to have reached a very high plateau, used in magnets for the green transition, particularly in things like wind farms. If you watched our piece on rare earth elements, you'll know that a big wind turbine uses up to a ton of neodymium. Nickel on rising steadily despite what we believe to be a surplus. Tin has had an absolutely amazing year. Ferrovanadium down with iron. Okay, and finally, precious metals. Richard.
Precious metals have underperformed during 2021. I think the average industrial commodity has gone up by around about 30% in 2021. The price of gold, silver, and indeed the other precious metals, these platinum group metals, simply have not followed those. So platinum, rhodium, palladium, we know it's basically because they're important. One of their major uses in car and diesel engine, so petrol and diesel engine exhaust systems, which have been severely curtailed through production cuts for other reasons. And gold and silver, you would have expected to have shone, pardon the pun, in these increasingly inflationary times, and they haven't. And I think that will inevitably reverse in due course.
Yeah, and there's been a bit of a bounce in the PGMs this week, but that's kind of contradicted by the fact that Toyota are going to close these 4 car plants.
Yeah.
So, that suggests that continued PGM weakness going into 2022.
Gold has gone nowhere for the year, as we know. Silver has gone less than nowhere for the year. Platinum, the other PGMs, we know they have done poorly this year for reasons we've just discussed.
It's rhodium. That is palladium. It had a bit of bounce last week, but still well down on the year. Okay, and finally onto rates. Now, interesting. Last week, we had UK base rate rise for the first time in a long time to 0.25%, and the bond market was very relaxed about it. Bond yields hardly moved. This week, they have moved. Now, is that a reaction to the UK borrowing requirements coming in much higher than expected? Are bond markets starting to move? So you see there were rises across the yield curve in the UK, and quite substantial ones. But the 30-year is still only yielding 1.1%. Watch this space. In Europe, the periphery bonds yields all rose, but still quite low levels. So we're indications of concern, but we don't have a bond crisis in Europe yet.
I just say, if you look at the Spanish 10-year, Keith, PPI, producer price inflation 30%, Spanish 10 yield 0.45.
Yeah, I know. It's absolutely mystifying. When we do a review of the year, Richard, that is the thing that I've got completely wrong. I just thought that rising inflation would inevitably lead to rising bond yields.
So at some point it'll break, Keith. And that's the discontinuity I'm referring to. At some point, Spanish bond yields will break, and there will be, and these discontinuities are what cause real damage when they run through the system.
Merry Christmas from Richard Wheater. So this is the Greek 10-year.
I would say.
This is the Greek 10-year. It's not coming down. Indications of concern. This is the Italian. Picked up a bit. Okay, UK 10-year. Starting to rise again. Unlike the US one. It's a clear break between the UK and the US. Is the market becoming concerned about the path of UK government borrowing? Finally, onto the seasonality chart, and fingers crossed, a good last week of the year. We could all do with it. Right. Richard, what have you been up to this week?
Thank you, Keith. So my weekly change was up 1.1%. My change for the year is up 9.1%. And FTSE All Share up 13.7%. So a better week for me, but not particularly good year, although I have high hopes for the last 8 days of this year. So I have decided that it would be useful to put my performance in context of my asset allocation. So this is my asset allocation. As you can see, it is a world end scenario asset allocation. So I have a lot of money in gold and silver miners. I have quite a lot in physical gold and silver via the Sprott physical ETFs. I don't have anything in non-physical ETFs because I don't believe they hold gold. I believe they hold paper certificates that entitle them to the gold until they need it and when they won't be able to get it. Copper miners, uranium, and miners. So uranium, because I have some yellow cake miners. Fossil fuels, for the same reason that Keith has his investments in coal, in oil. Mine include coal and gas. I think Keith includes gas. He can speak for himself, but I don't think you have any coal, do you, Keith?
No, I don't.
And then other various bits and pieces, and 3% in crypto. So although I have some crypto exposure, it's not very large. And this asset allocation follows my thesis that I believe that the global economy is in a bad place and that there has been so much money printing. We are going to move into a period of significant inflation and quite possibly stagflation. And it's really difficult to know where to put your money in those circumstances, where to put it that it's safe. It's a really difficult conundrum. So, Keith, how was your week?
Thank you, Richard. Well, I had a good week, up 2.7%, which takes me up to plus 8.1% on the year. 8.1%, which is behind Richard, behind Stuart, and behind the All Share, so not great, despite getting my calls on commodities bang on. So I was right on oil and gas. Anyway, I did a little fiddling around this week. So I sold some Lamprell, which had been a very poor investment. Essentially, they need money and they need to do a share placing, which they have the go ahead for. And I sold because I don't want to take part in the placing. So for a loss of 42%, my final weighting portfolio is 0.2%. So it was a small position. I also sold Parkmead, which is an oil and gas producer, basically has tiny producing fields, gas fields in Holland. And earlier in the year, as you'll see, the market seemed to be treating it as a serious gas producer, but then they realized actually its revenues were about 2.8 million quid. So its share price came off. And I think there's better uses for the capital. Closed out with a gain of 13%. It was a moderate sized position for me. Initial portfolio weighting 0.8%. Final weighting 0.9. Now, what did I buy? So thank you to our Discord members for our feedback. I put in my portfolio weighting and my conviction. Now, I bought more Hunting, which has been a terrible investment so far, down 30%. But I hope you watched our share talk on it. I remain very convinced by the company, and I think it's just a question of time before an oil and gas industry capex rises with a very high conviction. And I did the mugs game of buying your losers, so I added to it. Now, I also opened a position in Rio Tinto. Rio has lots of copper. Seems to be getting its act together in Mongolia with the massive Oyu Tolgoi copper mine. Finally, is that going to come online? And also, as Simon W. was pointing out, it's aluminium assets, mainly in Canada, where you have hydroelectricity. Aluminium prices are going to rise. And then finally, I bought some Cheniere Energy, which exports LNG from US, where gas prices are low, to the rest of the world, where gas prices are astonishingly high. Now, following Richard, this is my asset allocation, which is very different. So I'm 65% oil and gas. I have 17% miners. I still believe that interest rates are going to have to rise. So I'm 9%, 9.1% financials, mainly banks, UK banks, Lloyds, NatWest, Barclays. I have a small position in travel, which has not been great, but when things open up, Saga, watch our share talk, and Saga is going to do well. I have some clean tech. Tecmar has been a terrible investment, but eventually I think it's going to pick up. So a few gold producers, but much lower allocation, which is basically I sold the lot. I had 30% allocation. I sold it all back in March, and that was a good decision. Putting it all in oil and gas, less so. Then very little cash and a few small positions. My industrial stock is Hard-Eyed, which does tungsten coating hardening of components. Its customers are Airbus and the oil and gas industry. Okay, so this is Lamprel. You see when they announced essentially they needed to do a big fundraise, the share price collapsed. I should have sold it there, but I've hung on and finally just doing a bit of clearing up at the end of the year. I've sold it now. This is Parkmead. I sold from one of my accounts. I sold it all here. I held on for 50p, didn't get it, and I've sold it for 40. Hunting, well, has it turned up? My average price is about £2.20. Long way down. This is Rio Tinto. Opened a position, obviously quite small at the moment because I don't have any cash. But as in the new year, I tend to rearrange the portfolio and put some more money into Rio. I like Rio. This is Cheniere Energy. Now, I've only opened a tiny position in Cheniere because I like the trade, but it's come a long way. And that is it. So thank you all for watching. Thank you all for contributing to the channel with all your input. Richard and I have enjoyed doing it, and we are committed to another year. So Merry Christmas, everyone.
Merry Christmas, everyone. And we're not going to be doing one next week, are we, Keith?
No, we're not.
So you will have a week's peace from us.
Exactly. But I will be looking at all our share talk videos and updating, maybe not next week, but certainly into the new year. And at some stage, we'll try and do a review of the first year, etc., etc. But in the meantime, everyone take a break from the markets, eat some mince pies, open some prezzies, and we'll see you in the new year. So it's, please, can you press like and subscribe to the channel? And if you have some spare cash, send it our way, or a mince pie or something.
Mince pie, yeah. Or turkey.
Yeah. Have you seen the price of turkeys? Yes, send us a turkey.
We'll put it on eBay.
So Merry Christmas, and it's goodbye from Richard Weiser.
And goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, We make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.